Let's talk about option strikes, the exercise price, the level at which you have the right to exercise your option to buy or sell an underlying. Let's imagine we have a commodity, because it's tangible, it's easier to imagine, priced at $100. That's the spot price. If that is the price at which you have the right to buy or sell that commodity at a future point in time, the strike would be called at the money spot. If you had the right to buy the commodity or sell the commodity at the money forward, that would be at the forward price we calculate for a specific date. So let's just say today the commodity is valued at 100, but you want a 6-month option, and the forward price for the underlying would be 103. So if you have the right to buy or sell that commodity at 103, that is at the money forward. There's no profit or loss or intrinsic value in the option, it's just time value that's reflected in the price really. But what if you had the right to buy the commodity not at 100 but at 80? I mean, that's a really good price. You're paying 80 instead of 100, lucky you. That is in the money, ITM, and that's going to be a pretty expensive option. But conversely, what if you had the right to buy at, say, 120? So the market's saying, hold on, the price you're buying at should be 100. You have the right to buy it at 120. That's out of the money. That's 20% away from the current prices. It's out of the money. It's hardly likely to happen. It'll be cheap. Although the bank never likes to call something cheap, they call it cost effective. Now, one of the terms you need to come across, which we've discussed a bit before, is delta. If an option is struck at the money forward, that's what we think you should be paying. There's a 50-50 chance it could happen. So it's a delta of 0.5. If you have a call option, we'd say it's plus 0.5 delta. If the delta goes out of the money and is less likely to be exercised, the delta goes towards zero, tends towards zero. So if it's out of the money, maybe it has a delta of 25 delta. It's low delta, it's not likely to happen. But the more likely something is to happen, if you have like an option to buy something at 80, not 100, that's in the money, that's a high delta. Closer to 1, it's more likely to be exercised.